Thank you for watching this video. Today we will be doing technical analysis on the S&P 500 for the week ending Friday, August 26th, 2022. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. My name is Rodney Constable. I have over 30 years of investing experience, including over 25 years of experience trading stocks and options. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the developer and president of Simple Market Signals at simplemarketsignals.com. The chart that we will be working off of today is a weekly candlestick chart of the S&P 500 that goes back to for 1 year. So we're going to start with 1 year. We might change that time frame here throughout the video because we're going to be doing a deep dive and doing the analysis together. I've got it started with a couple of things, but we'll talk about that. But do want to clarify that each candlestick on this chart does represent 1 week of trading. This is a 1 year chart of the S&P 500. The blue line is the 4,300 line. I've got us started with that. And the green line, this downward trending line right now, that is the 40-week moving average. Okay, so it is a fairly common long-term moving average that a lot of technicians use on their charts. So I threw that in there for talking points and visual reference. But to start off with, let's talk about the performance of the S&P 500 this past week. It was kind of a tough week, down 4.04% on the S&P 500, and we closed at 40.5766. Now, if you want to see all of the data, it's right here, but it's in real small type there where my cursor is circling. So I've enlarged the important data points for us. Again, S&P down 4.04% this week, closing at 40.5766. Okay. Now, this 4,300 line, guys, this has been an important overhead resistance line for quite a while on the S&P 500. And any of you that have been with me for any length of time, you know that I've pointed out that round numbers, things ending in a double zero, as an example, oftentimes are very important support and resistance levels on a stock or on an index. And this goes clear back to the work that Jesse Livermore did clear back in the late 1800s, early 1900s. So I learned that from reading his material. So this is, these things have been going on for a long time, okay? So 4,300, a very important overhead resistance point, and we can see that 2 weeks ago we got up to that 4,300 level, and incidentally that also matched up with the downward trending 40-week moving average, and we got rejected. All right, we stalled 2 weeks ago on the S&P 500, and you may remember from last week's video I pointed out that we closed near the lows of last week, and of course we pretty much closed at the dead lows of this week, and we'll talk about that here in a second. But that rejection at 4,300 and the 40-week moving average was after a 4-week rally in the S&P 500, which is pretty rare in and of itself. As a matter of fact, if we go back and look, and this is where we'll start to mark some stuff up, have a little fun, play around with some of these tools, these annotation tools. So here's a 4-week burst on the S&P 500 where we went up 4 weeks, and if we go back, and again, we're going back 1 year, right? And we can see that if we look back 1 year on the S&P 500, we've had 2 of these instances over the last year where the market rallied at least 4 weeks, and this one was 5. And we can see what happened here after we rallied 5 weeks back in October, right, of 2021. Then the market stalled, and of course we know that we peaked in January, and we've been falling since. Well, we just had that 4-week rally, and I warned you guys because I know how rare these situations are, right, where the market goes up 4 to 5 weeks in a row, and what normally happens, and especially when you're in an environment like we are, then the market rolls over and falls. And the other thing to point out here, guys, is that every time the S&P 500 has gotten up to this 40-week moving average since the beginning of January, right? We've had these little rallies. Here's a couple weeks, and then we failed, right? We fell. Here's a 3-week rally, and then, we once again failed. Whoops, that arrow didn't go where I wanted it to, but I guess you guys get the point there. And then, of course, we just failed again at the 40-week moving average, all right? So, sometimes you can penetrate it by a day or two, or a week or two, excuse me, but it doesn't mean it's going to hold, all right? So there's a lesson in and of itself. Just because we get up above the 40-week moving average after being below it doesn't mean we're out of the woods, right? It can stay up above the 40-week for a week or two and then fail and roll back over, all right? So nothing is definitive when it comes to the stock market, guys. This is a fluid situation, and as traders and investors, we always need to be willing and able to make new decisions based on new information, all right? And I'm going to get rid of this arrow because it is not appropriate for what we're doing, all right? Now, I'm going to drop this particular circle out of the way because I want to draw a trend line here. And we're going to see here, if we draw a trend line at the bottom, I like to connect, and each technician is going to do things perhaps slightly differently, right? But the way I have learned over the decades and decades of doing this is connecting the bodies of the candles, all right? And you can clearly see when we connect the bodies of the candles that we have now broken below, right? With this last week, we broke below this uptrend, this counter trend rally, right? And a lot of people thought this was it, and the downturn was over. But I always felt like that was perhaps a little too convenient. And guys, look, there's a lot of guys out there that, the market's going to crash, and now I'm seeing this guy because I do some work in the real estate area as well. So, the housing market's going to crash. The stock market's going to crash. Crash. Guys, please, please, please ignore those people and ignore those channels. All right. I'm telling you, for your own good. All right. The people that have predicted the end of the world have been out there forever, and guys, the worst case scenario in life, I don't care whether it's in the stock market, in real estate, in business, in your personal life, the worst case scenario very seldom happens. All right, it does happen. It's happened in my life as well, but I can only really remember one or two instances, and it really revolved around a younger person in my family passing away, in a tragic way, right? Car accident or something else. So my not to get too personal, but the point is, guys, that these guys that are out there, and a lot of them. Look, I've been with StockCharts.com for 17 years, all right? A lot of these guys that are out there with these YouTube channels, and that's just my charting service. Now, think about that for a second, guys. I've been using the same charting service for 17 years. A lot of these guys that are out there, the market's going to crash, the world's going to come to the end, crash. They haven't even been out of high school or even maybe junior high or elementary school for 17 years, all right? So what do they know about life, about the stock market, about business, all right? I've been at this a long, long time, all right? And, so just kind of consider where the information is coming from. And, I want you guys to win. There's so much misinformation out there. And keep in mind, remember, I'm a former financial advisor, a former VP of a major mutual fund company. And I've also developed my own proprietary risk management and trend direction model, okay? So, guys, I'm a geek on this stuff, all right, and so I just want to try to help you here, and there's so much misinformation, and just please be careful. And I would ignore, if I were you, I would ignore those guys and those channels that are always predicting. I mean, go back over their videos. How many years now have they been predicting the crash? What does that even mean? All right, I don't want to get too on too much of a diatribe here on this, but if they can't quantify it, if they can't prove it in their work, if they can't show you with technical analysis where those downside support and resistance levels are, and then maybe come back and match it up with some earnings and PE numbers for the S&P 500, and if they can't make sense of what they're saying mathematically, ignore them, guys. Come on. Okay. Anyway, so and you're going to find with my work, I can always show you exactly, which is why I like doing the technical work with you. I can show you exactly how I'm arriving at these potential downside targets. And I say potential because, guys, I can't predict the future, but nobody else can either. All right. But we can look at if this, then that scenarios. That is the intelligent, mature way to approach technical analysis, right? So if you want to get better at technical analysis, if you want to get better at the stock market, please pay attention to what I just said. Don't take it for granted because it's so important, all right? And that's why I get, as you can tell, I get kind of crazy about this stuff. It just makes me nuts when people are so irresponsible and just trying to get clicks, right? Crash. All right, so with that off my chest, let's get back to work here. So we know that we broke beneath this uptrend line, and this was a counter trend rally, okay? And this market is starting to feel, to some degree, guys, to some degree, like 2000 through 03, that bear market. Now, technically, we're not in a bear market, all right, because you have to be down 20% or more, on whatever index. So in this case, the S&P 500, because it's the best proxy for the overall U.S. stock market. But we're not down. We're down about 16%. I'm just rounding that off for you. But at where we closed on Friday, the 26th, we're down about 16% roughly on the S&P 500. All right. So we've had a few weeks down in here where we closed in a bear market, but only a few weeks where we've been down 20% or more from our high back on January 4th of 48,1862. I don't have it annotated, but I just have it memorized. All right. So again, we need to be mature and we need to be accurate with our verbiage. A bear market is when you're down 20% or more on whatever investment you're talking about. In this case, the S&P 500, we're not down 20% or more, okay? But I think the potential is there for us to drop back into a bear market here, all right? So let's talk a little bit more about that. Guys, this 4,300 level, just to kind of, finish my thoughts on this and the work on this so you have it as well for a go-forward data point for yourselves. This is going to be important, all right? And you can see also, not only this 40-week moving average, which, by the way, when that 40-week moving average is turning down, that is not good, okay? So we've got a downward trending 40-week moving average, shows the weakness in the market. We keep getting rejected when we rally back to it. And yes, you can penetrate it for a couple of weeks and still fail, all right? So another important lesson for you, just because we get back above that 40-week moving average doesn't mean we're completely out of the woods. It's a good sign. It's a starting point, but it doesn't mean that we're out of the woods. But this last attempt, we didn't even close 1 week above the 40-week moving average, nor did we close 1 week above 4,300. As a matter of fact, if you look back here, the last time we had a weekly close above 4,300 on the S&P 500 was right here when my cursor is circling during that second week in April, all right? Other than that, every single weekly close that we've had has been below 4,300. So just kind of keep that in the back of your mind. That 4,300 level is going to be super important on a go-forward basis. So let's go ahead and pull up the Fibonacci. Now, this chart is probably going to get a little bit busy here, but that's part of the fun, right? But let's take a look here. And as a matter of fact, let's just look at this downturn that we just went through. And I'm going to drop this on here, but then bear with me here because I'm going to shorten up the chart so that we can really focus. I'm going to take this from a 1 year to maybe, let's just go back about 4 months and see what that looks like. Hit the update button. All right, so we'll kind of zoom in here on this chart. So what I've done here is I'm dropping this Fibonacci tool on top of at the tail end of the candle, right? The tail of the candle down here where we hit our bottom on June 17th and the recent peak on August 16th, Tuesday the 16th, is when we technically peaked back here. We're not going to get quite that granular. You can take a look on daily charts, weekly charts, or hourly charts. And by the way, in this week's newsletter, I do go into that as well. So that's part of, if you do subscribe or if you are a subscriber to Simple Market Signals, make sure you pay attention to that because I've got some charts in the newsletter that show you that, and I show you how little trading there was above 4,300 too during this last rally. So it's an important thing. So make sure you pay attention to that. But if we use the Fibonacci retracement tool, and of course we know that 38.2 and 61.8 are the two really important Fibonacci retracements. So what I'm looking at here, right, and what I'm trying to figure out is, based on this counter trend rally, if we pull back 38.2% of this entire rally, oh, guess what? It puts us almost exactly, as you can see here. And guys, I didn't premeditate this, right? This is just how this stuff works. You start to play around. You start to experiment. But look at this. This 38.2% retracement line lines up almost perfectly with where we closed this week. So we've already, right, based on this counter trend rally, we've already retraced 38.2% of the counter trend rally. All right. Now, if we retrace 50%, that's going to take us right down to somewhere around the, and guys, it doesn't have to be exact, but it gets you really, really close. All right. You can see, the 40, 57, 66, and where I drew the lines here, 40, 61 is 40, 61, 90, right? It's really tiny, but you can see it right there. Is where that 38.2% retracement drops in, based on where I drew the lines. So it's good enough, right? So we've already retraced 38.2% of this counter trend rally. If we retrace 50%, that's going to bring us down to right around 39.80, okay? And then if we retrace 61.8%, that's going to bring us down to 38.98, so 3,900 basically, all right? So 3,900 right here, all right? Now, if we retrace 100% of the move, that of course takes us down to that 36 and change that we hit back on June 17th, I think was the exact low. So this is the way this works, and it doesn't matter what time frame, all right? I mean, here we're looking at a shorter term time frame. You can do this over months, hours, weeks, whatever, and this is the way the Fibonacci tool works, okay? So, 38.2 and 61.8% are the main Fibonacci numbers. 50%, by the way, is not a true Fibonacci number, but it works out extremely well for whatever reason, right? When you do technical work, it's very common for the market or a stock or whatever, an index, to pull back 50% of its prior move, right? You get back 50% and then you move again. And it gets you, it's in a range, right? Don't be so critical that it has to be exactly 50%. We're getting in a range here, right? So we've already lost 38, a little over 38.2% of this entire move, and that happened in 2 weeks. After a full week rally, we know that those are rare. We know the market generally gives back some. We still have the Fed raising rates. I mean, guys, there's just a lot of stuff out there, and I'm not sure if I completed my thought here on this 2003 bear market. That this is starting to feel like that. And my point there, so I want to go back to that just in case I didn't drive that point home. It just felt like during that 2003 bear market, when I was working for Oppenheimer Funds at the time, the mutual fund company, every time the market started to pull out, we would get these counter trend rallies, right? And I'm talking again about that 2003 bear market. It just felt like every time we were starting to get some traction and get some good news, something else would happen and it would send us lower. And then it would happen again and again. And that's what made that bear market so long. Right, and it was one of the longest since 29 to 32, and very, very rare to be negative that many years in a row in a major indice. But this situation that we have now, and I am not saying that I don't make prediction, guys, because I can't predict the future, which is another thing. Be careful with any of these knuckleheads that are so arrogant that they think they can predict the future. Nobody can predict the future with really any accuracy, and of course, you might get lucky once in a while, but you can't do it over and over again, okay? My point is, the intelligent, mature way to approach these situations is to look at an if this, then that scenario. I learned that mindset by studying from other great traders and investors, okay? I've read hundreds and hundreds of books on the stock market, and of course, I've been at this for, many, many decades. I've placed thousands and thousands of individual trades for myself. I've worked with over 6,000 financial advisors throughout my career as a VP for Oppenheimer Funds. So, guys, I probably have a little bit more experience with this stuff than most people, okay? For what it's worth, all right? So the point is, guys, that where we end up, how low the market goes, is dependent upon what else might happen. Can we get resolution to some of these supply chain issues that are really at the heart of driving up inflation? Can we get resolution on some of these things, or do we end up in a negative feedback loop where more and more negative things keep happening because of the situation? And we don't know, but the potential, I just want to warn you, the potential is there for us to get stuck in this negative feedback loop where it continues to drive the market lower and lower from here, all right? And I touch on some of that, and I give you some downside targets in this week's newsletter. So make sure you subscribe, pay attention to the balance of the video, guys. Invest another couple minutes in yourself. And by the way, remember that, a couple of things here, okay? I want to work with people that have a growth mindset. I want to work with people that are autodidacts, okay? And if you're not familiar with that word, look it up. Autodidact basically means a self-educated person, and it doesn't matter whether you already have, your MBA or PhD or whatever. You have to continue throughout life to invest in yourself. You need to continue to invest in your knowledge. You need to continue to invest in your skill sets. And this type of stuff that I'm sharing with you is not taught in schools. It's not taught in universities, okay? And there's, again, so much misinformation out there. My work is based on the stock market itself, all right? I don't get into politics. I mean, it's not that I don't pay attention to it, but I don't look, people that want to work with conspiracy theories and politics and all of these things and try to get that to match up with the stock market, good luck, all right? Because it just doesn't work, all right? So you're not going to get that kind of stuff with me, right? You're not going to get conspiracy theories. You're going to get stock market based work. All right. So if you're willing to invest a few pennies a day in your own gray matter, in your own mind to continue to learn, if you want to become a better trader and investor, I'm in a position to help most of you. Okay. But you've got to help me help you. And the very first step along that journey is to invest the next couple of minutes and watch the balance of this video. Do you manage any of your own money, including in your 401k or IRA? Are time and money important to you? If time and money are important to you, then simple market signals should be important to you as well. Simple market signals is for business owners, busy corporate executives, and other professionals who want to cut through the stock market BS and get down to the facts. If you value your time, if you value your money, you need Simple Market Signals. Simple Market Signals is based on a proprietary formula developed by a former financial services professional with decades of real-world experience. Simple Market Signals is equity investing information simplified. Simple Market Signals saves you time and helps you understand market trends and risk management in a way few enjoy. Just try it. There's no contracts. You can cancel anytime, and a subscription to this information is less than 67 cents per day, and it's priced way less than it should be for the value it brings. To learn more, go to simplemarketsignals.com and watch this video that's on our homepage. So again, go to simplemarketsignals.com and watch this video that's on our homepage. Again, that website is simplemarketsignals.com.